Hi there. Welcome to Trading Day. Let's get to those big stories we're bringing you from the BNN Bloomberg newsroom. Some traffic through the Strait of Hormuz is increasing, with 21 ships transiting over the weekend. Now, that increase has led to the highest level in weeks. It's due to some countries, apparently including Iraq, securing safe passage deals with Iran. That country is granting exemptions to select partners, but it's moving ahead with legislation to formalize transit fees, possibly tightening its grip on global energy flows. And there's a look at shares in Barrick Mining. That company is slowing development of its potential Pakistan mine, Reko Diq. The company says it will scale back spending and extend a project review until mid-2027, citing worsening regional security conditions and possible increases in capital costs. Toys R Us Canada is battling the tech giant Acer, along with two other businesses, over trademarks it says will cause confusion with the company's own branding. The three firms filed applications to register a backwards R as trademarks. Toys R Us is opposing the use of names and symbols it says are linked to its brand to protect its proprietary rights and goodwill. The toy retailer remains in creditor protection. And there's a look at the TSX, marginally higher today, even though Iran has, for now, rejected a ceasefire proposal from the United States. U.S. President Donald Trump says Iran's counter-proposal is not good enough, but he called it a significant step. And you can see U.S. markets holding on to small gains. Okay, so President Trump did over the weekend provide a deadline for Iran. Unless he says we get a deal by tomorrow, he is going to go after electricity infrastructure. He's made that threat before. Let's get more on what effect this could have on Canadian investors. We're joined by Chris White, Head of Research at 5i Research. Thanks very much for joining us.
Thanks for having me.
Tell us what is the main theme that you're following in the market, or what's your strategy right now in this environment?
Yeah, definitely. Yeah. So the markets did gap higher this morning on the heels of some sort of potential 45-day ceasefire agreement. And, you know, what we've seen over the last few weeks has really been a lot of headlines. There's been a lot of noise and some conflicting statements. And so, you know, I think for investors, there's been a lot of headline fatigue and some level of confusion. But what I'm really looking at, I'm looking at a signal that cuts through all this noise. And for me, that's the price of oil. So I'm looking to see, you know, if the price of oil drops significantly on the day, maybe 10 to 15% on the heels of some sort of piece of news. I think that if that move in oil is sustained, that's kind of the market signaling and pricing in some sort of eventual either ceasefire agreement or the reopening of the strait.
And would part of your thesis there be if, say, oil drops, I think you said 5%, that would be a signal to buy equities?
I think so. I think if that signal is if the price of oil drops and that's sustained, and then we see some sort of grind lower in the price of oil, and that's accompanied by other factors, like if we see bond yields move lower, I think that that's the market signaling that inflation expectations could be lowering, as well as the VIX. That's a really important indicator for me as well.
What about gold? You're not mad keen on gold right now.
Yeah, that's right. Yeah, so I think, you know, gold has had this massive run on the heels of, you know, kind of a risk-off trade. There's been a lot of hedging, and that's been done through the price of gold. And we really saw gold make this parabolic advance over the last year. And I think that that's starting to weaken. It's starting to decelerate and break down potentially. And I think that there's some rotation happening out of gold. We're seeing a lot of gold miners start to consolidate some of those gains. And I think that's an easy area for investors to start, looking at where to take profits and where to rotate into. There's other areas as well for that.
For many years, investors favored companies that don't need to spend that much in terms of capex. They don't have big factories and just massive rusty metal hanging around their neck. But you're looking for these so-called halo stocks right now: heavy assets, low obsolescence.
Mm-hmm. Yeah, definitely. Yeah. So the halo theme has been pretty popular and trending recently. So this is essentially a theme that, these are names that are unlikely to be disrupted by AI. So we've seen a lot of software names really being beaten down on the basis that, AI models could disrupt their existing legacy businesses. And so investors are seeking safety and capital flight outside of those areas, looking to capex heavy areas. So for me, for what I'm looking for, I think I would be focusing on a barbell approach between AI halo names and non-AI halo names. And so AI halo names are essentially the capital intensive physical infrastructure type of names that power data centers that eventually lead to the training and inference for AI models. And then non-halo stocks, those are your typical, pipelines, energy infrastructure, utilities names that aren't benefiting from the AI models, but that acts as a hedge. And so I think by using that barbell approach, that really allows investors to benefit from both the structural tailwinds of AI and spending, and then also the hedging and capital flight areas like energy and pipelines.
So, for example, Cameco have massive physical assets, huge mines, and they are potentially a winner from AI if we get far more electricity demand.
Yes, definitely. Yeah, exactly. With uranium and some of the nuclear plants and just the need for this massive energy space and energy demand.
And another name, possibly Stantec, the engineering company. They, of course, could benefit if there's massive electricity construction, et cetera.
Yes, exactly. Yeah. And some other areas that we like as well include Hammond Power Solutions. So that's HPS.A, and then Celestica as well. And that's the ticker is CLS.
Let's get into some other ideas. This is an interesting company. I haven't seen them on BNN Bloomberg. They may have been on the channel. I'd love to talk to them. Kraken Robotics, and they're involved in undersea robotics. They've got a pretty good defense franchise.
Yeah, definitely. Yeah. So Kraken Robotics, the ticker is PNG. So what they do is they develop underwater robotics and sonar systems for naval defense. And, the real moat here is their sonar systems, which essentially map the ocean floor. So you can think of it as Google Maps, but for the ocean floor. They can detect underwater mines, and pipeline damage for energy, offshore energy. And, really part of the story here really is that its services segment is outpacing its core products portfolio. And that's enabling profitability and profit margin expansion. And, in January alone, they received a $35 million order for its subsea battery products. And that's a pretty substantial order for the company. And it's not cheap on a valuation basis. It certainly trades at a premium valuation. But I think that it'll continue to benefit from the structural tailwinds of growing global defense spending.
Your next idea is Celestica. Now, we might have touched on this. They have massive manufacturing plants, but they've been seen for a long time as a winner in AI. The stock is off its highs, though.
Yeah, definitely. Yeah. So Celestica, I think, is the best Canadian AI infrastructure play out there right now. And so what they do is they design the hardware systems and manufacture these hardware systems that go right into the hyperscaler AI data centers. So essentially, they take semiconductor chips, networking equipment, and power systems, and they manufacture them in into complete systems that can get dropped right into AI data centers. And, forward earnings estimates call for about 40% earnings growth. So it's definitely a growth story. And I think it's going to continue to benefit from the AI CapEx spending cycle. Like you mentioned, it has pulled back from its recent highs. So it's down to a valuation that I find, getting more attractive at 32 times forward earnings. And there are some risks involved. It does have a fairly concentrated list of customers. Its top 10 customers make up over 70% of its total revenues. But essentially, I think this is a name that's going to continue to benefit from the data center build-out. And I think that theme has a lot longer tail than most investors expect.
We're tight for time. Just talk to us a little about your final idea, EQB, the lender, big mortgage franchise for one thing.
Yeah, definitely. Yeah. So EQB, the ticker is EQB, and essentially they're Canada's digital first challenger bank. And so essentially, they're by being a digital first bank, that means that they have way fewer physical branches. That allows their cost structure to be quite lean, and they can compete on margins, and they can actually offer really attractive, interest rates on its products, and that allows it to compete. And I think part of the big story here is the PC Financial acquisition. It's expected to close this year, and that would, if it closes, quintuple its customer base and add 2 million in credit cards.
Chris, thanks very much indeed.
Thank you.
Chris White, head of research at 5i Research. Up next, we're going to hear from NASA's former chief economist about the costs and economics of building a long-term presence on the moon. As Artemis 2 circles the moon with Canadian astronaut Jeremy Hansen aboard, along with 3 American colleagues, space economists are analyzing the economic drivers behind renewed space exploration and what it will take to sustain an Artemis moon base. We heard from Alex MacDonald, senior associate at the Aerospace Security Project and former chief economist at NASA.
The goal of Artemis is to not just return to the surface of the moon, but actually build up a permanent presence there. So, we'll see where we get to, but the actual plan is to be able to build a habitat there, possibly multiple habitats now. In fact, last week, NASA rolled out a new set of commitments to robotic lunar landings prior to human landings, which are indeed scheduled for around the end of this decade. But they would be planned to continue through the 2030s with installation of power infrastructure, potentially R&D projects that might learn to use some of the resources that are on the lunar surface, like oxygen and water ice. So yeah, there's actually a relatively indefinite commitment that's happening here.
Is there a real economic payoff here, though? Because the moon is barren and they don't have much stuff. They don't have anything that I know of, maybe some isotope of hydrogen that isn't available on Earth.
Yeah, so the main economic benefit is really just the technological advancements that any country that invests in space exploration gets. My kind of favorite fact on that is that between 1960 and 1963, 75% of all global semiconductor demand came down to space programs.
Wow.
So basically, space programs became a way of scaling one of the most fundamental technologies of the modern world. GPS, telecommunications, satellites, space-based internet, all of these things come from investments in the space program. That is going to continue. In terms of this question of resources, the water ice is predominantly used for astronaut consumables as well as potentially rocket fuel. There is also discussion of helium-3, which is a different isotope of helium that might have use in fusion and potentially quantum computer cooling. So there's some potential applications, but really the main investment is really showing world leadership. As we know, during the Cold War, America's landing on the moon really kind of established U.S. technological supremacy. And there's going to be a similar process playing out here. China has its intentions to land on the moon by the end of this decade as well. And how and when the different countries land on the moon and the capabilities that are established will signal a significant amount of global leadership. So there's multiple different layers to the type of investments.
There have been, I mean, the original Apollo program was curtailed because of cost. And then there was another major initiative aimed at the moon, but that too was called off because of the expense.
That's correct. So we're now on our third attempt to return to the surface of the moon. Of course, right now, today, we are succeeding in the very first element of that. Today, there will be essentially a communications blackout period of about 40 minutes while Jeremy Hansen, the Canadian astronaut, and his three American NASA astronaut colleagues, Reed Weissman, Christina Cook, and Victor Glover, all go around the far side of the moon. That is happening today. And then they'll have a 4-day return back to Earth. So this has been the result of about 15 years of committed investment dating back to the 2010 NASA Authorization Act that Congress passed and was signed into law. The first attempt to try to return to the moon was the George H.W. Bush era Space Exploration Initiative. That submitted a bill to Congress of half a $1 trillion, over $1 trillion today in inflation-adjusted terms. That was canceled. So what NASA did to reestablish this program was to rely on two different core strategy elements. One was to rely on international partnerships, Canada being, of course, the first country to fly as part of Artemis. But there will be other countries as well. The U.S. is committed to landing Japanese astronauts on the lunar surface. The European Space Agency is also a major partner. They actually provided some of the service module that was used on this mission. So the international component will be lowering the cost and in getting more political kind of alliance benefits as well. And then the second major difference, of course, was the reliance on the commercial sector. The two companies with contracts to land astronauts on the moon are Blue Origin and SpaceX, which are respectively owned currently privately by Jeff Bezos and Elon Musk, the richest people in the world. So there's been a very different strategy that's been taken, and thus far that has proved to be very effective at getting a sustained program going here.
Yeah, I got my helium and hydrogen isotopes mixed up there for a second. Has Elon Musk, with his rockets, has he significantly lowered the cost of getting people into space?
So he has significantly lowered it, but not necessarily as much as people might realize. In fact, some of NASA's costs actually are going up. Where he's really succeeded is creating a vertically integrated company that has managed to use this capability to reuse rockets to launch his own Starlink satellites and create the largest constellation of satellites in history. So the cost has been reduced, but not necessarily by the many orders of magnitude that people have hoped for. Of course, Starship is looking to reduce the cost even further. If that vehicle is fully successful, it will be fully reusable, and the hope then will be to be able to reduce the cost of spaceflight by perhaps another order of magnitude. So we are seeing significant reductions in cost. We're seeing, perhaps even more importantly, significant increases in the number of launches. We're now up to 100 plus launches a year. This is the highest there's ever been. So we're really at a boom time in terms of space launch and particularly in terms of satellite production. We're now at well over 10,000 satellites in space. 75% of them are in fact owned by SpaceX for the Starlink satellite constellation. So there's certainly a lot more activity going on now than there's been in a long time.
Alex McDonald, Senior Associate at the Aerospace Security Project and former Chief Economist at NASA. Coming up, we'll look at why Canada may need to rethink the way it builds homes by boosting the productivity of each worker. We'll be right back. Major push in Canada to accelerate home building, although in some places, such as Ontario, the number has been stagnating. In any case, our guest says we really want to improve affordability in housing. We need to confront a major issue: productivity in residential construction. Let's get more from Murtaza Haider, professor and executive director of the Cities Institute at the University of Alberta. Thanks very much indeed for joining us.
My pleasure. Thank you for having me.
So you co-wrote an op-ed and you argue that one of the problems here is just worker productivity in residential construction has not been going up. Just talk about that problem first, if you would.
Absolutely. We worked with McDonald-Laurie Institute for about a year and wrote this report from which the op-ed you saw, analyzing the declining residential construction productivity, not just in Canada, but also in the United States. It so happens that of all the industrial sectors, residential construction or construction in general has the lowest productivity. What does it mean, in fact, is that we are using more workers, laborers now to produce a home than we did some 20, 30, or 40 years ago. And over the years, the building firms, construction firms have been spending more on labor than on investing in technology or capital to increase the productivity. The result is that we are building as many homes as we did in the 1970s, but with 3 times more workers. And that is a serious challenge, because if we continue to do this, we will be spending more. Our cost of construction will continue to increase, but our in throughput in annual construction would remain around 250 to 270,000 housing starts, which hasn't changed over the last many years.
That's interesting. Why has productivity per worker dropped?
Many reasons for it. First is that we have lot more regulation, red tape now. So a lot of workers are not just necessarily involved in construction; they're more so involved in compliance with the regulations and new laws and whatnot. We also have on the industry side lots of small firms. The construction sector in Canada is notorious for having a very large number of very small firms. In fact, there's only one construction firm with over 500 employees in Canada. This is from CMHC's research. So what does it mean for us? It means that these are small firms, too many, and they don't have the means to negotiate better rates, better wages, or better investment in technology, so they are able to produce more homes with less labor and are more efficient. So this atomized structure, this overly restrictive environment for construction, too much regulation and red tape, all has contributed to a decline in construction productivity.
And just expand a bit, if you could. Why would productivity have dropped over the years?
So over the years, so imagine, like, if you go back to 1970s, we built about 2.7 million homes in that decade. And the number of workers, I would believe, was no more than 250,000 then. And then slowly we see that we are investing more and more in labor, and the cost of construction has gone up. If you look at the construction cost indices, they have gone up by 60, 70, 80% since the onset of the pandemic. So basically, we haven't invested in maybe perhaps training the workers to be more productive. In fact, there's a good example that one of the economists in Toronto used, and he said, if you take a pilot from the 50s and drop them in a cockpit of a modern plane today, they wouldn't know what to do. But if you take a construction worker from the 50s and drop them at a construction site today, they'll be more efficient probably than most workers, because they have known the shortcuts and everything. So that's a problem, that we have too many workers. We have not perhaps trained them, because that's why we are using more homes. And at the same time, in fairness to the industry, the homes today are also much larger and more complex than the homes that were built in the 60s and 70s. So all these factors are at play. But what is needed desperately for Canada, if we want to change this, is to invest more in industrial production of housing, modular prefab construction. In industrialized environments, we produce more, the higher throughput, bring them and assemble them in record time. So bring the construction time down from months or years into 3 months or less. That is the way forward, and we have to invest significantly, especially for the Build Canada Home, that is government's new initiative, looking at construction and increasing productivity. Why don't they invest in producing social non-market housing, use and invest deeply in the modular production of homes, and fix 2 problems: increase the productivity and also increase the supply of social housing in Canada?
The construction industry is notoriously conservative, though, isn't it? I think it was the Toronto Star had a piece recently. People wanting to put in heat pumps were told by loads of contractors, oh, it won't work in this climate, simply because they didn't want to learn a new skill and do things differently.
I wouldn't go that far. I mean, I work very closely with the industry, and I see innovations. It's just that those who are bigger builders, who build maybe 2,000 homes or more, they have the means and the capacity to invest in technology and train their workers to be more productive. It's the challenges with those who build 5, 10, 50 homes a year. They don't have the means or the deeper pockets to be able to invest in capital rather than labor. So what they do is, when they get more work, they just get more workers, rather than thinking that there's a better way of increasing their profit profitability, lowering the cost of construction, reducing the time of construction, and be more productive at it. And that requires investment in industrialized housing.
Murtaza, thank you very much. Murtaza Haider, Professor and Executive Director at the Cities Institute at the University of Alberta. Coming up, Barrick Mining slowing development of its Pakistan project amid security concerns. What will this mean for the miner? Next. OPEC and its allies have agreed to raise their oil output quotas by more than 200,000 barrels a day. But that's in May. Of course, it's a modest increase compared to perhaps 5 million or more barrels a day of supply that's been lost in the current Gulf War. Many of OPEC's key members are actually unable to raise production due to the same conflict, the US-Israeli war with Iran. Saudi Arabia, the Emirates, Kuwait, and Iraq were the only countries in the group that were able to significantly raise production prior to the conflict. A new polling suggests a majority of Canadians think Canada should explore joining the European Union. The survey by Spark Advocacy found that 1 in 4 Canadians think it's a good idea for this country to formally join the economic and political bloc, while 58% indicated the proposal was worth exploring. Spark says the results suggest Canadians are increasingly open to finding ways to reduce Canada's reliance on the United States after more than a year of tariffs under President Donald Trump. And shares in Soleno Therapeutics are surging. That's after Neurocrine Biosciences agreed to buy the drug maker for $2.9 billion US. The biotech will pay $53 a share for Soleno, which represents a premium of 34%. Neurocrine wants to boost its portfolio and get more access to drugs for rare diseases, including Soleno's pill for a rare disorder that causes patients to have extreme hunger episodes. There is a look at the TSX. It is hanging in right now, up still more than 40% in the past 12 months, but off its highs amid this fighting in the Middle East. And there are U.S. markets. They are rallying a little bit today. As we mentioned, Barrick Mining is slowing development of a big mine in Pakistan, citing security concerns in the region. Let's get more from John Ing, CEO of Maison Placement Canada. John, thanks very much indeed for joining us.
Good to be here, Andrew.
According to TD, this is only about 4% of the net asset value for Barrick right now, I guess before it's built, et cetera. So maybe they're deciding it's more trouble than it's worth?
Well, it's not more trouble than it's worth. It's a question of timing. Reko Dig, Andrew, it's in southwest Pakistan, but it's in Baluchistan, which is the province, and that borders Iran, Afghanistan, and it's in Pakistan. So it's definitely near and located in an area where there are currently jets, bombs, etc. And you just don't want to be thinking about building something that big. It's a $6 billion project, up from, I think it was $4 billion. So it's a fairly large expenditure. And I think the logic is that perhaps we should just wait a while and see what develops.
Because they are focused on Nevada right now as they work on the possible IPO of those assets.
Well, it's a long-term project and has been for some time. It is, after all, the prize is there. There's something like 5 billion tons of copper, pounds of copper. There's a 500,000, it could be a 500,000 ounce a year of annual gold production. It's could last 37 to 40 years of mine life. It's a huge project. It's copper, gold. Copper, as we know, the world needs it, and it will be desperate in the next few years. This project, Andrew, was not supposed to sort of come into production not till 2029. So the price tag has increased. There's expectation that prices itself will likely increase. So it makes a lot of sense to go slow. Important, however, is that Reko Dig is something like 14 million ounces of gold in the ground. And for Barrick, that's a significant down the road. So my guess is that they will keep the project on the stove, so to speak, but it's not one that one would abandon. The risk reward is too appealing, in my opinion.
There's a lot of moving parts at Barrick these days, aren't there? Especially this potential IPO of their crown jewels, their Nevada and Dominican Republic assets.
That's right. I mean, there is the intention to spin off Nevada Goldfields, or a portion of it, something like 10 to 15%. To me, I would want to own more of it rather than spin off some to the public. It is the world's largest gold complex. It is rich in resources. Barrick has something called the 4 Mile Project, which is another potentially 500,000 ounce a year producer outside the project. They could, according to the agreement, flip that into the Nevada Gold venture, which they share with Newmont, and in fact make it worth even more from a valuation standpoint. So there's, as you say, there's a lot of moving parts. If I were running Barrick, I would want on more, not spin off less.
Why are they doing that? I guess it's the old financial engineering. They think that those U.S. and Dominican republics will get a big fat valuation.
Well, that's right. I mean, a geopolitical world is so uncertain nowadays. Parts of, as we see with Reko Dig itself, is in Pakistan. Also, there is, Barrick has in Africa, Lumwana. And so all mining companies, other than, say, something like Agnico, have mines in areas of the world that are risky jurisdiction. But frankly, mining is risky itself. There are some institutions which don't want to be in that area. And I think that that's the appeal of a spinoff. Have something that's an all-American, including the Dominican Republic, of course. But my sense is that when you look even at Newmont, which is the world's biggest gold miner, they are in parts of the world where one would not normally want to be or sometimes even visit.
No, that's right. Yeah. What's the old rule? If you wouldn't go on holiday with your family there, don't invest in it. Agnico, of course, you mentioned Agnico. It has achieved this pretty rich value or decent valuation because it's seen as being in safe jurisdictions.
Well, that's right. It's in the largely Canada, Australia, Mexico. It's interesting. Its founder, Paul Penna, once said he doesn't want to build a mine where you can't wear an overcoat. And Sean Boyd then branched out from Canada and put them into Mexico. Also, Agnico has some mines in Finland. But from a geographic point of view, Andrew, Agnico is in preferred jurisdictions, and it produces gold at a big profit, and thus the premium. Sometimes you can't have everything at the same time.
John, that's right. Thank you very much. Really appreciate it. John,
good to be here.
CEO of Maison Placement. When we come back, apparently 62% of Canadian professionals are feeling burnt out. We'll have more after the break. according to a new survey, 62% of Canadian professionals are feeling burned out, up from 47% from late 2024. Let's find out what's happening behind this growing strain in the workplace. We're joined by Tara Parry, Director of Permanent Placements at Robert Half. Thank you very much indeed for joining us. What do you mean by professionals? Can you just set the stage for us, please?
It's a good question, Andrew. Professionals are who we define as the workforce that we work with. So people who you would mostly find in an office building, in a downtown financial core. So accountants, lawyers, human resource professionals, supply chain, purchasing, technology, most of the staff that you might find in any corporate office.
And almost 2/3 are feeling burnt out, and it was just under 50% in late 2024. So that's quite an increase.
It's quite an increase, and we're almost up 100% from 2023 when it was 33%. So it's a huge increase over the last few years, and it's got our eyebrows up a little bit as to why. There's a myriad of factors, but as you can probably we're all living in this state of global uncertainty at the moment, whether it's economic uncertainty or geopolitical uncertainty. We're all coming into work with a slightly heightened state of just life anxiety and $2 gas at the pump. And now you combine that with understaffed teams and fear of job security and the input of AI in how we work from a day-to-day perspective. And you just have all of these inputs that are just creating the perfect storm.
And staffing cutbacks are a big part of it. People feel there's just not enough colleagues to get the work done.
Absolutely. And that's been a recurring theme over the last couple of years. That's not new. The sentiment around that continues to increase. And so when you have this political uncertainty and this economic uncertainty, companies are afraid to hire substantially because of the what if factor. What if tariffs increase again? What if we lose our markets? What if we enter a recession and now we have increased headcount? So organizations have been really slow to hire or rehire when there's been general attrition. And so you wind up with teams being asked to do more with less. And you see that case in point where 40% of professionals surveyed did not take all of their time off in 2025. Now, 60% did, but 40% didn't. And they didn't take their time off because they were afraid of the workload they'd come back to. They were afraid to burden their team with increased workload while they were gone, or there was just no one to do any of the work while they were away, and that just wasn't an option under the current circumstances. So, it's getting tight, and employers need to be careful with that.
It's interesting, isn't it? Yeah, we've got AI now in the mix, and I do remember seeing a headline in the Wall Street Journal that maybe you'll find out, yeah, sure, it enables you to get more work done, but then you'll just be loaded with more work.
And that's the fear. This is the first year we tracked any of that. Now, we asked workers what is attributing to your burnout more this year than last year, and not a ton of people came back and said AI. It was 1 in 6 respondents said AI is a leading factor for why they're feeling more burnt out this year than last. So it's not a huge number of reporters, but it's enough for us to sort of pay attention to it. And AI is everywhere, and it's in every business conversation these days. And we're seeing that play out because of the increase in expectation. And so, yes, teams are understaffed, but a lot of employers are coming back and saying, well, use AI and streamline things or become more efficient. But employees are saying, well, we don't have time to learn how to use AI properly because we're just trying to get the work done. And now there's this added stress of, if I don't adopt this technology effectively, am I going to lose my job? And yet it's another technology that we have to learn and adapt to on top of a new accounting system or a new purchasing system or a new, there's all of these layers. And so there's some tech fatigue that is happening as well.
And in some cases, you're presented with this tech and you're told, well, it's your job now to download it and implement it. Nobody's going to come around and show you.
Nobody's going to come around. Yeah, we had a different survey a couple of weeks ago, maybe a month or two ago now, which showed that most employers are not offering formal training on AI and yet have an expectation that their staff is learning how to use AI, which rings all kinds of other alarm bells because you're just asking your staff in a very ungoverned way to start to adopt these generative systems. And it's not ideal as an employer to just have your teams working willy-nilly through some of these systems, but that's what's happening. And that's the expectation. And that's what is spurring more of this burnout that we're seeing.
Tara, thank you very much. Tara Parry, Director of Permanent Placements at Robert Half. Still ahead, we got market movers with Bloomberg's Natalia Knežević. We are going to dig into a rally in AMC Entertainment. Natalia Knežević of Bloomberg joins us now. Natalia, thank you very much. It's great to see you. We are seeing strength in AMC Entertainment, the movie chain.
Hi, great to see you as well. Yes, so we see that the stock jumped by as much as 12% today. That's the biggest intraday move since March 1st. So the company said that it delivered a record-setting performance over the 5-day Easter holiday weekend. AMC said that it reached the highest combined revenue for global admissions as well as food and beverage. So revenue for this holiday frame from April 1st to April 5th in its 106-year history. It said that 6 million guests attended global AMC locations here in the U.S. and internationally. In terms of specific movies, they said that Super Mario Galaxy was leading the performance. I did not go to the movie theater. I was watching the love story about JFK Jr. and Carolyn Bessette.
You know, my wife has checked that one out. I don't care. I don't care about the Kennedys, but that's me. That's me.
It's a beautiful story. It's about 99. I mean, you should watch this. Please do it.
Yeah, no, and it's a very sad story as well. SLNO,
True.
Remind us what stock that is and why it's of interest today.
Yeah, so Solena Therapeutics, basically it's a biotech company. It's a relatively small business, but we saw a huge move in stock price. It was up by as much as 33%. It came after Neurocrine Biosciences, it's another therapeutic developer, agreed to acquire the drug maker for $53 per share. It is a 34% premium to its closing price on Thursday. Basically, this transaction represents equity value of about $2.9 billion. And this transaction will expand access to different kinds of drugs. And we know that both company boards approved this transaction. It is expected to close within 90 days. Analysts are also pretty much optimistic. Cantor said the valuation is low relative to potential that they believe the company will get from some of the Solena Therapeutics drugs.
Natalia, thank you very much indeed. Maybe I'll give that show a chance. Really appreciate it. Natalia Knežević of Bloomberg. We're out of time on trading day. Thank you very much indeed for watching the show. Stay tuned, though, to BNN Bloomberg all day as we watch these gyrations in oil and the markets. Stocks, of course, hanging on to narrow gains today. There is some optimism that both the U.S. and Iran do want to move towards some kind of a ceasefire, although Iran, from public consumption, is saying it's got to be a permanent deal. Thanks again for watching and have a great afternoon.